venture capital need no introduction. Sequoia Capital. October 1999. The dot-com bubble is reaching its manic peak. Every venture capital firm is funding e-commerce clones, banner ad businesses, and eyeball accumulation strategies with no real business models. Money is flowing into anything with a .com in its name. Valuations have lost all connection to reality. The Nasdaq has tripled in 18 months. But Sequoia Capital's Michael Morates is passing on deal after deal. While competitors deploy billions into internet pet supply companies and online grocery delivery startups, Sequoia stays disciplined. The firm that backed Apple, Cisco, and Oracle isn't caught up in the frenzy. They are waiting for something different. Then two Stanford PhD students walk in with a search engine idea. No revenue model. The market looks saturated. AltaVista, Yahoo, Excite, and Lycos are already fighting for market share. Everyone Morates respects thinks search is solved. It is a feature, not a business, they say. The smart money is moving on to the next thing. But Morates sees something different. He pulls out a legal pad and writes down a simple framework that Sequoia has refined over 25 years. The best product in a huge market always wins, even without a business model. It is not complicated. It is not fancy. But it is a filter that has separated Sequoia from every other venture capital firm since 1972. Larry Page and Sergey Brin have built something 10 times better than any competitor. Their search results are shockingly accurate. The technology behind PageRank is genuinely novel. But more importantly, these founders care about product quality with religious intensity. They are not chasing a quick flip. They are not interested in plastering ads everywhere to generate revenue. They want to build the best search engine in the world, period. This is not guesswork. Morates has seen this pattern before. Steve Jobs cared about product design with the same fervor. Larry Ellison was obsessed with beating IBM. John Chambers understood that networking infrastructure would define the future. These were not mercenaries chasing trends. They were missionaries solving problems they cared about deeply. Sequoia will invest $12.5 million in Google at a $250 million valuation. Over the next 11 years, that investment will return for $0.3 billion. That is 216 times their money. It will become the single most profitable venture capital investment in history up to that point. But this moment reveals more than one great investment. It reveals a system. A way of seeing that allowed Sequoia to identify Apple in 1978, Cisco in 1987, and Google in 1999 while others chased consensus. It reveals a framework for evaluating founders that could not be copied because it required decades of pattern recognition. It reveals a network effect that meant the best entrepreneurs called Sequoia first. The secret was not individual genius. It was institutional knowledge compounded over generations. It was a culture that valued truth over ego. It was a partnership structure that aligned incentives perfectly. It was relationships built over decades that provided proprietary access to opportunities. To understand how Sequoia became the most successful venture capital firm in history, we have to go back to the beginning. Back to 1972, when Silicon Valley barely existed and venture capital was an industry of maybe 50 people. Back to a moment when the entire structure of technology investing was about to change, and one man saw it coming before anyone else. 1972. America is at an inflection point. The post-war economic boom is ending. Stagflation is beginning. President Nixon has just taken the dollar off the gold standard. An oil shock is coming that will send prices soaring. The stock market has been stagnant for 6 years, with the Dow at 1,000, exactly where it was in 1966. Interest rates are rising. Inflation is accelerating. A recession is looming. But something else is happening that most people do not see yet. Intel, founded just 4 years earlier, has invented the microprocessor. At Xerox PARC in Palo Alto, researchers are inventing personal computing. Semiconductors are enabling possibilities that did not exist 5 years ago. The technology that will transform the world is being developed in labs and garages across Northern California. The venture capital industry barely exists. Maybe 50 to 75 people are doing venture capital in Silicon Valley. There are wealthy individuals making angel investments. There are a few pioneering firms. But that is about it. The total amount of venture capital invested annually across the entire United States is roughly $100 million. Today it is $700 billion. The investment approach is primitive. East Coast bias dominates, with most capital concentrated in Boston and New York. Investors prefer manufacturing over technology. They write checks and hope for the best, with minimal involvement. They are looking for quick flips, not decade-long partnerships. Typical investments are $50,000 to $200,000, barely enough to fund a serious technology company. Nobody is building a system for startup investing. There is no methodology for finding the best founders early. There is no playbook for helping companies scale. There is no network effect across a portfolio. There is no brand that attracts the best entrepreneurs automatically. There is no focus on technology as the defining investment theme of the future. Into this gap steps Don Valentine. He is 40 years old, leaving National Semiconductor to start his own venture capital firm. But Valentine is not a typical investor. He has spent his entire career in the semiconductor industry, selling and marketing the most advanced technology products in the world. He understands technology at a level most investors never will. He knows the companies, the engineers, the founders. He has relationships everyone wants. Donald Thomas Valentine was born in 1932 in Westchester County, New York. He grew up solidly middle class, the son of a construction foreman. He was smart, driven, intensely competitive. He went to Fordham University, a Jesuit school in the Bronx, where he studied chemistry and learned the Jesuit method of rigorous analytical thinking. After college, Valentine spent 3 years in the Army. Then he joined Raytheon Semiconductor Division in 1959. This was the dawn of the semiconductor age. Transistors were replacing vacuum tubes. Silicon was replacing germanium. A handful of companies were inventing technologies that would change everything. Valentine was not an engineer, but he could talk to engineers. He understood the technology well enough to explain it to customers. He was a brilliant salesman. In 1967, Valentine joined Fairchild Semiconductor as sales manager. Fairchild was the most important company in Silicon Valley at that time. It was where the integrated circuit was commercialized. It was where Gordon Moore and Robert Noyce worked before leaving to found Intel. It was the training ground for dozens of entrepreneurs who would start the most important semiconductor companies of the 1970s and 80s. At Fairchild, Valentine learned how technology companies actually worked. He learned how to identify promising new technologies early. He learned how to evaluate engineering talent. He learned which markets were about to explode and which were overhyped. He built relationships with every important technologist in Silicon Valley. When engineers left to start companies, they remembered the sales guy who understood their products and respected their work. In 1967, Valentine moved to National Semiconductor as head of sales and marketing. National Semi was one of the Fairchild spin-outs. Valentine helped build it into a major competitor. He learned how to scale a technology company from 10 million to 100 million in revenue. He learned how to structure deals, negotiate with customers, and build distribution channels. He learned the operational side of technology businesses. But by 1972, Valentine was ready for something different. He had spent 13 years selling semiconductors. He had made good money but was not wealthy. He had watched dozens of engineers leave to start companies. Some succeeded spectacularly. Most failed. He noticed patterns in who succeeded and why. He saw that the venture capital industry was broken, leaving enormous opportunities on the table. Valentine had a vision. He would start a venture capital firm focused exclusively on technology companies. Not a side project or a hobby, but a dedicated institution. He would invest in semiconductors, computers, and software, the technologies he understood deeply. He would find the best entrepreneurs before anyone else and help them build great companies. He would use his industry knowledge and relationships as competitive advantages. He would build something that outlasted him. The vision was contrarian. Most investors thought technology was too risky. The big money was in manufacturing, retail, oil and gas. Technology companies failed all the time. The markets were small. The products were complicated. Why focus there exclusively? Valentine saw what others missed. Technology was getting cheaper and more powerful exponentially. Markets that were small today would be huge tomorrow. The companies being started in 1972 would define computing for the next 30 years. If you understood the technology and could identify great founders, the returns would be extraordinary. In October 1972, Valentine founded Sequoia Capital. The name was deliberate. Sequoia trees are among the oldest and largest living organisms on Earth. They grow slowly but endure for thousands of years. They tower over everything else in the forest. That is what Valentine wanted to build. An institution that would endure and dominate. The first office was modest. A small space in Menlo Park, the heart of Silicon Valley. One secretary, Don Valentine, and a yellow legal pad. That was the whole firm. Valentine invested his own money initially, then raised capital from wealthy individuals who trusted him. The first fund was $3 million, small even for that era. But it was a start. Valentine's investment thesis was simple. Back exceptional founders building technology products in large or rapidly growing markets. Do not invest in ideas or business plans. Invest in people. Find missionaries, not mercenaries. Find people who are obsessed with solving a problem, not people who are obsessed with getting rich. Find technical founders who understand their product better than anyone else in the world. The first investments revealed Valentine's approach. He invested in Atari in 1975 when it was just Nolan Bushnell and a handful of engineers making video games. Everyone thought video games were toys. Valentine saw a new form of entertainment that would become a massive industry. He invested in Apple in 1978 when Steve Jobs was 23 years old and the personal computer industry did not exist yet. He invested in Cisco in 1987 when two Stanford network administrators wanted to help computers talk to each other. These were not obvious bets. Apple's first product was a wooden box with a circuit board that you had to assemble yourself. Cisco was two people in a garage with no business experience. Atari was making primitive games with blocky graphics. Most investors passed. Valentine saw something different in the founders. The Atari investment reveals Valentine's framework perfectly. Nolan Bushnell was a visionary who understood that computing would become entertainment. He was not trying to sell to corporations or governments. He was trying to sell to regular people who wanted to have fun. That insight, that computers could be consumer products, was radical in 1975. Valentine did not invest in Atari because the business plan was great. He invested because Bushnell was a missionary. Bushnell cared about creating magical experiences. He would work 20-hour days to make the games better. He attracted talented engineers who believed in the vision. That was what mattered. The Apple investment is even more revealing. When Valentine first met Steve Jobs in 1977, he almost threw him out of his office. Jobs was arrogant, abrasive, and unwashed. He wore sandals and had terrible body odor. He had no business experience and no credibility. He was asking for money to build personal computers when everyone knew computers were for businesses and required trained operators. But Valentine looked past the surface. He asked Jobs questions for 2 hours. He asked about the product, about manufacturing, about the market, about competition. Jobs had thought deeply about every detail. He cared about the corner radius of the case. He cared about the fonts on the screen. He cared about the color of the plastic. He was obsessed with making a product that was not just functional but beautiful. Valentine saw the missionary intensity. He saw someone who would never ship a mediocre product. He saw someone who would drive everyone around him crazy but would also attract the best designers and engineers in the world. He saw someone building for the long term, not the quick exit. Valentine did not lead the investment. He brought in Mike Markula, a former Intel executive, to actually run the company alongside Jobs and Steve Wozniak. That was another part of Valentine's approach. He did not just provide capital. He helped assemble teams. He made introductions. He recruited executives. He was hands-on when needed but knew when to stay out of the way. By 1980, Sequoia was established. The firm had invested in a dozen companies. Some had succeeded spectacularly. Some had failed. Valentine was learning constantly, refining his framework, building his network. When portfolio company founders needed to hire engineers, they called Valentine first. When entrepreneurs left established companies to start something new, Valentine heard about it before anyone else. The network effects were beginning. The 1980s would test everything Valentine had built. The personal computer revolution was accelerating. IBM entered the PC market in 1981, legitimizing the category. Microsoft and Intel were emerging as dominant forces. Apple went public in 1980 and made Valentine and Sequoia extremely wealthy. But success brought new challenges. Sequoia needed to evolve beyond Don Valentine. The firm needed a second generation of partners who could carry the culture forward. Valentine needed to transfer the pattern recognition framework he had developed over 15 years to people who had not lived through the same experiences. He needed to systematize what had been largely intuitive. In 1982, Valentine hired Pierre Lamond, his former colleague from National Semiconductor. Lamond was a trained engineer with deep technical expertise. He complemented Valentine perfectly. Valentine understood markets and founders. Lamond understood technology and product development. Together, they could evaluate opportunities from multiple angles. Throughout the 1980s, Sequoia invested in dozens of technology companies. Electronic Arts in 1982, which would become the dominant video game publisher. LSI Logic in 1981, a semiconductor design company. Oracle in 1983, which would challenge IBM's database dominance. The Oracle investment reveals another dimension of Valentine's framework. Larry Ellison was a complicated person. He was charming and brilliant but also ruthless and dishonest at times. He cut corners. He overpromised to customers. He had a reputation for being difficult to work with. Most investors avoided him. Valentine saw past the flaws. Ellison was driven by competition more than money. He wanted to crush IBM. He wanted to prove that a small startup could beat the most powerful technology company in the world. That competitive fire, that refusal to accept second place, was exactly what Valentine looked for. Missionaries were often difficult people. That was okay as long as they were building great products. Oracle went public in 1986. The stock tripled on the first day. Over the next 30 years, Oracle would become worth over $300 billion. Sequoia's early investment returned hundreds of times their capital. But more importantly, Ellison became part of the Sequoia network. He referred entrepreneurs. He gave advice to other portfolio companies. He helped recruit executives. The ecosystem kept growing. In 1987, Sequoia invested in Cisco Systems. This investment would define the firm's success for the next decade. Cisco was founded by two Stanford computer scientists, Leonard Bosack and Sandy Lerner, who wanted to help computers on different networks communicate with each other. They had built routers that could connect incompatible systems. At the time, networking was a niche corner of the technology industry. Most people assumed mainframe vendors like IBM would dominate. A startup making routers seemed like a small opportunity. Valentine saw something different. He saw that computer networking would become fundamental infrastructure. He saw that as companies bought more computers, they would need ways to connect them. He saw a market that could become enormous. More importantly, he saw founders who deeply understood the technical problem. Bosak and Lerner were not business people. They were engineers who had spent years building networks at Stanford. They knew the limitations of existing solutions. They had created something genuinely better. That technical insight, that depth of understanding, was what Valentine valued most. Sequoia invested $2.5 million in Cisco in 1987 at a $15 million valuation. Valentine joined the board. He helped recruit John Morgridge as CEO, bringing in adult supervision for the technical founders. He helped build the sales team and establish distribution channels. He used his relationships to get Cisco in front of customers. Cisco grew explosively. Revenue went from $0 to $100 million in 4 years. The company went public in 1990 at a $500 million valuation. Over the next decade, Cisco would become one of the most valuable companies in the world, worth $500 billion at its peak in 2000. Sequoia's stake would be worth over $7 billion. But Cisco's success created a problem for Sequoia. The firm had been built around Don Valentine. His experience, his relationships, his pattern recognition, his decision-making. Valentine was now in his late 50s. He would not be investing forever. Sequoia needed a succession plan. In 1986, Valentine had hired a young investor named Michael Morates. Morates was 31 years old, a Welsh immigrant who had studied history at Oxford, worked as a journalist at Time magazine, and written a book about Apple's early days. He was not the typical venture capital hire. He was not an engineer. He was not a former entrepreneur. He was not from Silicon Valley. But Valentine saw something in Morates that others missed. Morates was intellectually curious to an extreme degree. He asked better questions than anyone Valentine had met. He could talk to engineers about technical details, then turn around and explain complex ideas to non-technical people. He wrote beautifully. He thought historically, seeing patterns across different eras and industries. He was humble despite his obvious intelligence. Most importantly, Morates had the missionary intensity Valentine valued. He cared about building something enduring. He wanted to understand what made great companies great. He was willing to work harder than anyone else. He would spend weeks researching a single investment. He would visit factories, talk to customers, and interview competitors. He was relentless. Valentine gave Morates an apprenticeship. For 3 years, Morates watched Valentine work. He sat in every meeting. He read every investment memo. He asked questions constantly. Why did you invest in that company? Why did you pass on this one? What did you see that others missed? What questions revealed the most truth? By 1989, Morates was making his own investments. His first major success was PayPal, which he found through the network. A Sequoia portfolio company introduced him to Peter Thiel and Max Levchin. Morates saw missionaries building financial infrastructure for the Internet age. The company went through multiple pivots and near-death experiences, but Morates never lost faith in the founders. PayPal eventually sold to eBay for $1.5 billion. But the investment that would define Morates' career came in 1999. That was Google. The story of how Sequoia won that investment reveals everything about what made the firm special. By 1999, Sequoia had a massive network advantage. Sequoia had backed Apple, Cisco, Oracle, Yahoo, and dozens of other successful technology companies. The firm's reputation attracted entrepreneurs automatically. When Larry Page and Sergey Brin decided to raise venture capital for their search engine, they talked to every major firm. But they connected most deeply with Sequoia. Morates spent weeks getting to know Page and Brin. He visited them at Stanford. He used their search engine obsessively. He talked to other search engineers to understand the technical innovation behind PageRank. He asked about their vision for the company, their willingness to stay for the long term, their approach to product development. What convinced Morates was the missionary intensity. Page and Brin did not care about making money from banner ads. They cared about organizing the world's information. They talked about search quality with the same fervor Steve Jobs talked about product design. They had strong opinions about how advertising should work, refusing to compromise user experience for short-term revenue. They were building for decades, not for the next funding round. Morates recognized the pattern. He had seen it in Steve Jobs 20 years earlier. He had seen it in Larry Ellison, in Jerry Yang and David Filo at Yahoo, in Mark Andreessen at Netscape. Great founders were missionaries obsessed with their product. Everything else followed from that. The negotiation revealed Sequoia's position. Multiple firms wanted to invest. Page and Brin could have chosen any venture capital firm in Silicon Valley. They chose Sequoia for two reasons. First, Morates was the only investor who truly understood what they were trying to build. He asked about algorithms, not business models. He talked about product quality, not revenue projections. He got it. Second, Sequoia had the network. Google would need to hire hundreds of engineers. Sequoia knew every engineering manager in Silicon Valley. Google would need partnerships with Yahoo, AOL, and other portals. Sequoia had those relationships. Google would need help navigating rapid growth. Sequoia had helped Apple, Cisco, and Oracle scale from startups to public companies. Sequoia invested $12.5 million in June 1999 at a $250 million valuation, owning about 10% of the company. Kleiner Perkins invested the same amount simultaneously. Morates joined the board. Over the next 5 years, he would attend every board meeting, help recruit executives, provide strategic advice, and watch Google become the most important company on the internet. Google went public in August 2004 at $85 per share, a $27 billion valuation. Sequoia's stake was worth nearly $3 billion. The firm had returned its entire $200 million fund from a single investment. Over the next 15 years, as Google's stock price increased another 10 times, Sequoia's total return from Google would exceed $10 billion. But the Google investment reveals something deeper than one great return. It reveals how Sequoia's competitive advantages compounded over 30 years to create an almost unbeatable position. The informational advantage came from 3 decades of pattern recognition. Morates had studied hundreds of technology companies. He had watched dozens succeed and fail. He knew what great founders looked like because he had seen them up close for years. When he met Page and Brin, he could instantly recognize the missionary quality that predicted success. The relationship advantage came from Sequoia's reputation. The firm had backed Apple, Cisco, Oracle, Yahoo, and PayPal. Every successful entrepreneur in Silicon Valley knew the Sequoia name. When founders raised money, they wanted Sequoia on their cap table. That meant Sequoia saw every great deal, got invited to every competitive investment, had first crack at every hot startup. The network advantage created a flywheel. Each successful investment produced founders, executives, and employees who stayed loyal to Sequoia. When they started new companies, they called Sequoia first. When they needed to hire, they asked Sequoia for introductions. When they saw interesting startups, they made referrals. The network kept expanding, creating more deal flow, more pattern recognition, more success. The process advantage came from 30 years of refining the evaluation framework. Sequoia did not make decisions by committee. Individual partners had autonomy to invest. But they shared insights constantly. Every investment was debated. Every success and failure was analyzed. The firm kept getting smarter about what mattered and what did not. The cultural advantage came from Valentine's founding vision. Sequoia was not about exits and IRRs. It was about building iconic companies. Partners were paid well but not extravagantly. The firm reinvested profits rather than distributing them. Partners stayed for decades rather than jumping to the next opportunity. That long-term orientation attracted founders who thought the same way. By 2000, Sequoia had become the dominant venture capital firm in technology. But the firm faced its biggest test yet. The dot-com bubble was about to burst. The 1990s bull market ended in March 2000. The Nasdaq peaked at over 5,000, then crashed. Within 2 years, it would lose 78% of its value. Trillions of dollars of wealth would evaporate. Hundreds of internet companies would go bankrupt. The venture capital industry would nearly collapse. Sequoia was not immune. The firm had invested in dozens of internet companies during the bubble years. Some were great businesses like Google, PayPal, and Yahoo. Some were momentum plays that would not survive. Sequoia's funds raised in 1998 and 1999 were underwater. The firm's reputation took a hit. But the crash revealed Sequoia's true strength. While many venture capital firms shut down or retreated, Sequoia kept investing. The partners recognized that the best companies are often started during recessions. When capital is scarce, only missionaries start companies. Mercenaries go work at established companies for safe paychecks. Economic downturns filter out the noise. In 2004, Sequoia invested in a Harvard student social networking site. Mark Zuckerberg had dropped out to work on Facebook full-time. The company had 1 million users, all college students. Revenue was zero. The business model was unclear. Zuckerberg was 20 years old with no business experience. Most venture capital firms passed. Social networking had been tried before. Friendster was fading. MySpace was peaking. The market seemed saturated. Zuckerberg was demanding a $100 million valuation for a company with no revenue. He was insisting on control, refusing to sell to Yahoo for $1 billion. He seemed arrogant and inexperienced. Morates and his colleague Jim Getz saw the missionary intensity again. Zuckerberg did not care about revenue. He cared about connecting people. He talked about building a social utility that would include everyone on Earth. He was methodical about product development, testing every feature carefully. He attracted brilliant engineers who believed in the mission. Sequoia invested $12.7 million at a $98 million valuation. Zuckerberg gave up a small percentage of the company but maintained control. Over the next 8 years, Facebook would become the dominant social network, reaching 1 billion users by 2012. Sequoia's investment would eventually be worth over $8 billion. The Facebook investment cemented a pattern. Sequoia did not chase hot deals. They did not overpay for valuations. They found missionaries before anyone else and supported them unconditionally. They were patient, holding investments for decades if necessary. They focused on product quality and founder vision, not business models and revenue projections. Between 2000 and 2010, Sequoia invested in YouTube, which sold to Google for $1.6 billion. They invested in LinkedIn, which went public at $9 billion. They invested in Airbnb when it was 3 guys renting air mattresses. They invested in WhatsApp when it was a simple messaging app. They invested in Dropbox when cloud storage seemed like a crowded market. Each investment followed the framework. Find missionaries solving problems they care about deeply. Find founders with technical insights competitors lack. Find products that are 10 times better than alternatives. Find large or rapidly growing markets. Invest early, support unconditionally, hold for the long term. By 2015, Sequoia had evolved again. Morates had stepped back from day-to-day investing due to health issues. Doug Leone and Jim Getz were now leading the firm. A new generation of partners was joining. Rolof Boa, who had been CFO of PayPal before joining Sequoia, was becoming one of the most successful investors of his generation. Boa exemplified Sequoia's approach to talent development. He was not a typical venture capital hire. He was a trained actuary from South Africa who had worked in finance at PayPal. But he had the missionary intensity. He cared about helping founders build great companies. He was intellectually curious, asking better questions than anyone else. He was humble despite obvious success. Sequoia gave Boa an apprenticeship similar to what Morates had received 20 years earlier. He sat in on every meeting. He learned the framework. He built relationships. He made small investments and learned from mistakes. By 2010, he was leading major deals. Boa's investments revealed the same pattern recognition. He invested in Instagram when it was a photo-sharing app with 13 employees. He saw missionaries obsessed with product quality. He invested in Square when Jack Dorsey was trying to democratize payments. He invested in YouTube when it was 3 former PayPal employees in a garage. The Instagram investment shows how Sequoia's network effects continued compounding. Kevin Systrom and Mike Krieger started Instagram in 2010. They had previously worked on a different app that failed. When they pivoted to photo sharing, they called investors they knew. One introduction led to Sequoia. Boa met with Systrom and Krieger for hours. He used Instagram obsessively, understanding the appeal immediately. He saw missionaries who cared about beautiful product design. He saw viral growth unlike anything since Facebook's early days. He saw a market opportunity in mobile photography that most investors did not appreciate. Sequoia invested $750,000 at a $7.5 million valuation in February 2011. 18 months later, Facebook acquired Instagram for $1 billion in cash and stock. Sequoia's return was roughly 78 times in less than 2 years. The investment would eventually be worth billions as Facebook's stock increased. But the Instagram outcome was not luck. It was decades of pattern recognition, network effects, and relationship advantages compounding. Systrom and Krieger knew Sequoia's reputation. They knew Sequoia had backed Google, YouTube, and PayPal. They wanted that brand associated with their company. That gave Sequoia access. Boa knew what great consumer products looked like because he had studied them for years. He had been inside PayPal, YouTube, and other successes. He recognized the missionary intensity in Systrom and Krieger immediately. He could move fast because he trusted his pattern recognition. He did not need committees or lengthy due diligence. He knew. By 2020, Sequoia had been investing for nearly 50 years. The firm had backed Apple, Cisco, Google, Facebook, Instagram, WhatsApp, Airbnb, DoorDash, Stripe, ByteDance, and hundreds of other successful companies. The total value created by Sequoia-backed companies exceeded $3 trillion. No other venture capital firm came close. But success created new challenges. Sequoia's funds were now measured in billions, not millions. The firm was investing globally, with offices in China, India, and Israel. The team had grown from Don Valentine and a secretary to over 100 investment professionals. How do you maintain culture across that scale? How do you transfer pattern recognition to people who did not live through the same formative experiences? Sequoia's answer was to systematize the framework that Valentine developed intuitively. The firm created explicit criteria for evaluating founders. They looked for missionaries, not mercenaries. They looked for technical founders who understood their product better than anyone. They looked for people who attracted great talent. They looked for obsessive attention to product quality. They looked for long-term thinking. They also looked for specific psychological traits. Great founders had to be learning machines who adapted quickly. They had to be comfortable with uncertainty. They had to have high pain tolerance, bouncing back from failures. They had to have unreasonable conviction, believing in their vision even when others doubted. They had to balance confidence with intellectual honesty, knowing when to pivot. Sequoia created playbooks for helping companies scale. They had seen hundreds of companies grow from 10 people to thousands. They knew the common failure modes. They knew when to hire a CFO, when to expand internationally, when to focus on profitability versus growth. They could help portfolio companies avoid mistakes they had seen others make. The firm also created systems for maintaining relationships. Partners stayed in touch with founders for decades. They attended company events, provided advice, and made introductions. When founders started second or third companies, Sequoia was the first call. The network kept compounding. By 2023, Sequoia managed over $85 billion across multiple funds. The firm had invested in over 1,000 companies. The portfolio included some of the most valuable companies in the world. Sequoia had helped create millions of jobs and trillions of dollars in economic value. But the story of Sequoia is not just about financial returns. It is about a framework for identifying and supporting exceptional people. It is about compounding advantages over decades. It is about building an institution that outlasts any individual. It is about the power of pattern recognition and network effects. The secret of Sequoia's success was not access to better deals, though they had that. It was not smarter analysis, though they were smart. It was not better relationships, though they had those too. The secret was a systematic framework for evaluating founders that Valentine developed over decades and that his successors refined and passed down. Most investors evaluate startups by looking at markets, technology, and business models. Sequoia looks at founders first. Are they missionaries or mercenaries? Do they care about their product with religious intensity? Do they attract exceptional talent? Do they think long-term? Do they have technical insights others lack? Can they articulate a compelling vision? These questions seem simple, but answering them accurately requires decades of experience. It requires seeing hundreds of founders and tracking which traits correlate with success. It requires intellectual honesty, admitting when you are wrong and learning from mistakes. It requires a culture that values truth over ego. Valentine developed this framework through painful trial and error. His first investments in the 1970s taught him what mattered. He invested in some companies that failed because the founders were mercenaries chasing trends. He passed on some companies that succeeded because he misjudged the founders. Each mistake taught him to look deeper, ask better questions, and trust certain signals. By the 1980s, Valentine had refined the framework into something repeatable. When he hired Morates, he could teach it. When Morates hired Boa, the framework could be passed down again. That institutional knowledge, that accumulated pattern recognition, became Sequoia's competitive moat. The Google investment perfectly illustrates the framework. In 1999, most investors saw a crowded search market with no business model. Morates saw two missionary founders obsessed with product quality. He saw technical insights that created a 10 times better product. He saw a huge market that most people underestimated. He saw the same pattern he had seen in Jobs, Ellison, and Young. That pattern recognition, built over 30 years, allowed him to make a contrarian bet that seemed obvious in retrospect. The Facebook investment reinforces the lesson. In 2004, most investors saw an arrogant college dropout with no business experience. Morates saw a missionary founder obsessed with connecting people. He saw viral growth and engagement that indicated product-market fit. He saw the same missionary intensity he had seen in Page, Brin, and Jobs. The framework told him to invest, even though the valuation seemed high and the business model was unclear. This is what made Sequoia different from every other venture capital firm. Most firms invest based on market analysis, financial projections, and competitive dynamics. Those things matter, but they are not predictive. Markets change. Projections are always wrong. Competition is fluid. What matters is the quality of the founder. Great founders succeed regardless of market conditions. They pivot when their initial idea fails. They attract great talent when resources are scarce. They outwork and outthink competitors. They build products customers love. They create value even in terrible markets. That is why Sequoia focuses on founders first. The challenge is that evaluating founder quality is much harder than evaluating markets or technologies. Markets can be quantified. Technologies can be tested. Founder quality requires judgment, intuition, and pattern recognition. It requires thousands of hours of experience meeting founders and tracking outcomes. It requires intellectual honesty to admit when you are wrong and learn from mistakes. That is why Sequoia's competitive advantage is so defensible. Other firms can copy the strategy of focusing on founders. They can claim to look for missionaries. They can write blog posts about pattern recognition. But they cannot copy the accumulated experience, the decades of data, the institutional knowledge. When Morates meets a founder, he is drawing on 35 years of experience meeting thousands of founders. When Boa evaluates a deal, he is using frameworks refined over 50 years. That pattern recognition cannot be taught in a classroom or learned from a book. It requires living through cycles, making mistakes, tracking outcomes, and refining intuition. Sequoia also built structural advantages that reinforce the pattern recognition advantage. The partnership structure aligned incentives perfectly. Partners were well paid but not extravagantly wealthy. The firm reinvested profits into new funds rather than distributing everything to partners. Partners stayed for decades, building relationships and compounding knowledge. The brand advantage created network effects. Sequoia became the first call for great entrepreneurs. That meant the firm saw every great deal, got access before competitors, could be selective about which investments to make. They could pass on 99% of deals and still have more great opportunities than they could fund. The portfolio advantage created cross-selling opportunities. When Google needed to hire engineers, Sequoia introduced them to talent from other portfolio companies. When Airbnb needed international expansion advice, Sequoia connected them with founders who had done it successfully. The portfolio became a platform, with each company helping others succeed. The capital advantage gave Sequoia patience. The firm could hold investments for decades. They did not need to force exits to return capital to limited partners. They could support founders through multiple pivots, economic downturns, and competitive threats. That patience attracted founders who wanted long-term partners, not short-term financial engineers. These advantages compounded over 50 years to create a nearly unbeatable position. By 2020, Sequoia was larger, more successful, and more dominant than ever. But the firm's leaders recognized that staying on top requires constant evolution. The technology landscape was changing rapidly. Artificial intelligence was becoming real. Cryptocurrency was challenging traditional finance. Biotechnology was merging with software. Climate technology was attracting serious capital. Sequoia needed to adapt without losing the core framework. The firm also faced new competition. Tiger Global and other hedge funds were moving into venture capital, writing bigger checks at higher valuations. Corporate venture arms had unlimited capital. Founders had more options than ever. Sequoia's brand advantage was still strong but not unassailable. Sequoia's response was to double down on founder relationships while expanding geographically. The firm opened offices in China, India, Israel, and Southeast Asia, applying the same framework in new markets. They invested in earlier stages, doing more seed deals to build relationships before companies became hot. They created new fund structures to compete with hedge funds on later stage deals. But the core framework never changed. Find missionaries obsessed with their product. Find technical insights that create 10 times better solutions. Find large or rapidly growing markets. Invest early, support unconditionally, hold for the long term. That approach worked in 1972 and it still works today. The story of Sequoia teaches several lessons about building enduring institutions. First, focus on what is unchanging. Markets change. Technologies change. But human nature is constant. Great founders have the same traits across generations. They are missionaries, not mercenaries. They are obsessed with product quality. They attract great talent. They think long-term. Focus on evaluating those traits and you will succeed in any market. Second, compound advantages over decades. Sequoia's success was not from one great investment or one brilliant insight. It was from systematically building advantages year after year. Better pattern recognition. Stronger relationships. Bigger network effects. More institutional knowledge. These advantages compounded like interest, creating exponential returns over time. Third, transfer knowledge systematically. Valentine could not remain the sole decision-maker forever. He needed to teach Morates, who needed to teach Boa, who needs to teach the next generation. That required making implicit knowledge explicit. documenting what worked and what did not, creating frameworks that could be taught, building a culture of learning. Fourth, stay humble and curious. Sequoia made plenty of mistakes. They passed on companies that became huge. They invested in companies that failed. But they learned from every mistake. They refined their framework constantly. They never assumed they had all the answers. That intellectual honesty, that willingness to admit error and adapt, kept them ahead of competitors who became complacent. Fifth, optimize for the long term. Sequoia was not trying to maximize returns this quarter or this year. They were building an institution that would last generations. That meant sometimes passing on quick flips to support founders building for decades. It meant reinvesting profits instead of distributing everything. It meant being patient when others panicked. The impact of Sequoia extends far beyond financial returns. The company Sequoia backed transformed industries and changed how people live. Apple made computing personal and beautiful. Google organized the world's information. Facebook connected billions of people. YouTube democratized video creation. Airbnb changed how people travel. DoorDash transformed food delivery. Stripe modernized payments. These companies created millions of jobs directly and tens of millions indirectly. They generated trillions of dollars in economic value. They funded pension plans for teachers and firefighters. They enabled millions of small businesses to reach customers. They gave voice to creators who could not access traditional distribution. They solved real problems for real people. Sequoia also shaped how venture capital works. They pioneered the focus on founder quality over market analysis. They demonstrated the power of network effects and long-term partnerships. They showed that missionary founders building iconic products generate better returns than mercenaries chasing trends. Dozens of venture capital firms copied Sequoia's approach, raising the standards across the industry. The alumni network created its own impact. Dozens of Sequoia partners left to start their own firms, bringing the framework to new markets and sectors. Portfolio company founders became angel investors, funding the next generation of startups. Employees of Sequoia companies started thousands of new companies. The knowledge and relationships spread exponentially. The permanent capital structure introduced in the early 2020s represents the latest adaptation. Rather than traditional 10-year venture funds that force exits, Sequoia created an evergreen fund that can hold investments indefinitely. This aligns with how the best companies create value over decades and how the best founders think about building businesses. The Sequoia fund structure allows the firm to hold on to winners like Google and Airbnb indefinitely. They can capture decades of compounding value rather than being forced to sell after 10 years. This generates better returns while maintaining alignment with founders who are also building for the long term. The structure also provides flexibility to return capital to limited partners when they need liquidity while maintaining exposure to the best investments. Limited partners can withdraw from the fund periodically but do not force the entire fund to liquidate at a predetermined time. This solves a fundamental problem with traditional venture capital fund structures. Most importantly, the permanent capital structure signals to founders that Sequoia will be a true long-term partner. The firm can credibly commit to supporting companies for decades, not just until the fund matures. This commitment is valuable to missionary founders who are building for generations. It differentiates Sequoia from firms still operating with traditional structures. Don Valentine started Sequoia with a simple insight. The quality of the founder matters more than anything else. That insight, executed systematically for 50 years, created one of the most successful investment firms in history. The framework guided decisions across multiple technology waves, economic cycles, and leadership generations. The accumulated knowledge and relationships created competitive advantages that strengthened over time. The culture and values attracted exceptional people who made the institution even stronger. Today, Sequoia manages over $85 billion, has backed over 1,000 companies worth trillions collectively, and remains the most prestigious name in venture capital. The firm continues finding and supporting missionary founders building important companies. The next generation of partners applies the same framework Valentine developed 5 decades ago. The institution he created has achieved the permanence he envisioned, towering over the landscape like the ancient trees it is named after. Sequoia demonstrated that systematic evaluation of founder quality generates better returns than analyzing markets or technologies. They proved that long-term partnership creates more value than transactional investing. They showed that institutional knowledge and network effects compound over decades. They built an organization that transferred culture and capabilities across multiple generations. These achievements provide lessons far beyond venture capital. Any field where identifying and developing exceptional people matters can learn from Sequoia's approach. The emphasis on intrinsic motivation over credentials. The systematic evaluation of character and capability. The patient support through difficulties. The long-term orientation. The commitment to learning and intellectual honesty. The building of trust through consistent integrity. Organizations trying to sustain excellence across generations can study how Sequoia transferred knowledge and culture. The apprenticeship model for developing talent. The documentation of decisions and outcomes. The collaborative culture combined with individual accountability. The structural alignment of incentives with long-term success. The promotion of people who embody values and execute strategy effectively. The maintenance of standards despite growth pressures. What made Sequoia exceptional was not that they avoided difficult trade-offs. It is that they executed their chosen strategy better than anyone else. They identified great founders earlier. They supported them more effectively. They held investments longer. They generated higher returns. They built an enduring institution. 50 years from now, Sequoia Capital might look completely different. The partners will be different people. The markets will be different. The technologies will be unrecognizable. But if the firm still exists and still succeeds, it will be because the framework endured. Because new generations learned to identify missionaries and support them unconditionally. Because the institution valued long-term thinking over short-term results. Because the culture prioritized learning and truth-seeking over ego and politics. That is how institutions become immortal. Not through brilliant individuals, though those help. Not through lucky timing, though that matters. Through frameworks that capture wisdom and transfer it across generations. Through cultures that attract great people and make them greater. Through structural advantages that compound over decades. Through missions that outlast any individual life. Sequoia Capital achieved what Don Valentine envisioned in 1972. An institution that would endure like the sequoia trees it is named after. Growing slowly but surely. Towering over everything else in the forest. Surviving fires and storms that killed competitors. Standing for generations as a monument to patient capital, long-term thinking, and systematic excellence. The story of Sequoia is ultimately a story about the power of frameworks and the importance of institutional knowledge. It is a story about how accumulated experience becomes competitive advantage. It is a story about how culture and values attract great people who compound that advantage. It is a story about how doing things right compounds over time to create extraordinary outcomes. That is the real lesson for anyone trying to build something enduring. Define your framework. Refine it constantly through experience. Transfer it systematically to the next generation. Build culture around it. Optimize for the long term. Stay humble and curious. Learn from every mistake. Compound advantages over decades. Never stop improving. Do that consistently for 50 years and you might build something that outlasts you. Something that matters. Something that changes the world. Just like Don Valentine did when he started Sequoia Capital in 1972 with nothing but conviction about what made great founders great and the discipline to act on that conviction repeatedly for 5 decades. The remarkable thing about Sequoia's story is how simple the framework is at its core. Find people who care deeply about solving important problems. Back them unconditionally. Support them for decades. That is essentially the entire strategy. Yet executing it consistently over 50 years required extraordinary discipline, judgment, and institutional capability. The simplicity is deceptive. Anyone can articulate the framework in a sentence. But knowing which founders truly care deeply versus those who just say they do requires years of experience. Distinguishing between genuine missionary intensity and performative passion takes refined intuition. Identifying which problems are truly important versus which are trendy takes wisdom. Supporting founders unconditionally without enabling poor decisions takes judgment. These capabilities develop slowly through repeated cycles of investment, observation, and learning. Valentine made his first technology investments in the early 1970s. By the early 1980s, after investing in dozens of companies, he had developed real pattern recognition. By the early 1990s, after 20 years, his intuition was highly refined. By the early 2000s, after 30 years, he had seen almost every variant of founder psychology and company trajectory. That accumulated experience became Sequoia's competitive moat. When Valentine evaluated a founder, he was drawing on 30 years of data. When Morates joined in 1986 and spent 3 years apprenticing, he was downloading 15 years of Valentine's pattern recognition. When Morates evaluated founders in the 2000s, he combined his own 20 years of experience with Valentine's framework. The knowledge compounded across generations. This is why new venture firms struggle to compete with Sequoia even when they claim to follow the same approach. A firm founded in 2020 has 3 years of data. Sequoia has 50 years. That difference matters enormously when evaluating founders. The questions sound the same, but the ability to interpret answers differs dramatically. Consider how Sequoia evaluated Mark Zuckerberg in 2004. A 20-year-old college dropout with no business experience demanding a high valuation and refusing to sell to Yahoo. Most investors saw arrogance and immaturity. Morates saw missionary intensity that reminded him of Steve Jobs 25 years earlier. That pattern recognition, developed over decades, allowed him to see what others missed. Or consider how Boa evaluated Brian Chesky when Airbnb was struggling in 2009. The company had launched multiple times with minimal traction. Revenue was tiny. The market seemed small. Investors were skeptical. But Boa saw founders who were obsessively focused on creating magical guest experiences. He had seen that obsessive attention to detail in successful founders before. The pattern matched. These investment decisions look obvious in retrospect. Of course, Facebook and Airbnb would succeed. But at the time, they were highly uncertain bets that most investors avoided. Sequoia's partners had conviction because they had seen similar patterns before. The framework gave them courage to back founders when conventional wisdom said to pass. The framework also helped Sequoia avoid costly mistakes. They passed on thousands of companies that seemed promising but lacked missionary founders. They avoided trends that generated excitement but not lasting value. They resisted pressure to invest in hot deals at inflated valuations when founder quality was questionable. The discipline to say no protected capital and preserved returns. This defensive use of the framework is often overlooked. Everyone focuses on Sequoia's successful investments in Google, Facebook, and Airbnb. But the firm also avoided Pets.com, Webvan, and countless other failures that destroyed billions in the dot-com bubble. They passed on social networks that fizzled, e-commerce companies that burned through capital, and enterprise software companies that could not compete. Avoiding losers matters as much as picking winners. The framework acted as a filter that removed investments where the founder was not a missionary regardless of how attractive the market or technology appeared. If the founder was primarily motivated by money or status, Sequoia passed. If the founder could not articulate why they cared about the problem, Sequoia passed. If the founder was unwilling to commit for a decade or more, Sequoia passed. These filters eliminated most opportunities. This filtering discipline required confidence that came from decades of validation. When everyone else was excited about an opportunity, saying no was psychologically difficult. You risked looking foolish if the company succeeded. You faced pressure from limited partners who wanted you to invest. You questioned whether you were missing something others saw. But Sequoia's partners had seen this movie before. They had watched missionary founders outperform mercenaries hundreds of times. They had seen hot markets attract capital that destroyed returns. They had watched technical founders beat professional managers repeatedly. The accumulated evidence gave them conviction to stick with the framework even under pressure. The partnership structure reinforced this discipline. Partners had autonomy to make investment decisions but were accountable for results over decades. They could not blame committees or process. If they invested in a mercenary who failed, that was their judgment error. If they passed on a missionary who succeeded, that was their mistake to own. This accountability kept standards high. The compensation structure also aligned incentives properly. Partners were paid primarily through carry on successful investments, not through management fees. They needed their investments to succeed over 5, 10, or 20 years to generate significant wealth. This eliminated incentives to chase short-term trends or invest simply to deploy capital. Partners thought like owners because they were owners. The limited partner base consisted of sophisticated institutions like university endowments, foundations, and pension funds that understood long-term value creation. They did not pressure Sequoia to chase quarterly returns or invest in hot sectors. They trusted the framework and gave the firm patience to execute. This limited partner base was carefully cultivated over decades and became another competitive advantage. Sequoia also structured fund economics to align with the long-term orientation. Management fees were reasonable, not excessive. Carry percentages were standard, but the firm reinvested heavily rather than distributing everything. Hurdle rates ensured partners only earned carry after returning capital plus reasonable returns to limited partners. These economic terms attracted mission-driven partners, not compensation maximizers. The office culture reflected the values. The Menlo Park headquarters was understated, not lavish. Partners worked in open areas, not private offices. The atmosphere was serious and focused, not flashy or self-promotional. The firm avoided publicity, rarely speaking to press or attending conferences. Everything communicated that success came from backing great founders, not from personal branding or public relations. This low-profile approach served multiple purposes. It kept partners focused on the work rather than personal fame. It reduced distractions from the core mission of finding and supporting founders. It maintained humility essential for intellectual honesty and learning. It also gave the firm optionality to operate without public scrutiny that could limit strategic flexibility. The approach to board service reflected similar values. Sequoia partners joined boards to help companies succeed, not to control them. They asked hard questions but respected founder autonomy. They provided advice when asked but did not micromanage. They supported founders through difficult decisions rather than panicking. They thought like partners, not overseers. This hands-on but not heavy-handed approach attracted founders who wanted engaged investors without interference. Many entrepreneurs specifically sought Sequoia because they knew the firm would support their vision while providing experienced counsel. The reputation for founder-friendly engagement created competitive advantage in winning deals. The portfolio company event Sequoia hosted demonstrated the commitment to value add beyond capital. The firm brought together founders across the portfolio to share insights and build relationships. They created forums where founders could learn from each other's successes and failures. They facilitated introductions between portfolio companies for partnerships and knowledge sharing. The portfolio became a community, not just a collection of investments. These network effects generated value for everyone involved. A founder struggling with international expansion could talk to another who had done it successfully. A company looking to hire engineers could get referrals from other portfolio companies. A founder considering an acquisition could get advice from others who had bought companies. The collective knowledge of the portfolio was greater than any individual firm could provide. Sequoia also invested in building platform capabilities that helped all portfolio companies. They created recruiting teams that could source executive talent. They built marketing expertise that could help with product launches. They developed financial and legal resources that could assist with complex transactions. These capabilities made Sequoia more valuable than firms that just provided capital and board seats. The investment in platform capabilities required significant resources but generated multiple returns. It made Sequoia more attractive to founders, helping win competitive deals. It improved portfolio company success rates, generating better investment returns. It created more loyalty among founders, strengthening the network for future deal flow. The platform became self-reinforcing. But building these capabilities also required careful balance. Too much infrastructure creates bureaucracy and slows decision-making. Too many services creates dependency rather than empowerment. Too much involvement undermines founder autonomy. Sequoia had to provide value without becoming overbearing. The firm managed this balance by making services optional and responsive to founder needs. Portfolio companies could access support when helpful but were not required to use it. Partners asked whether founders wanted involvement before providing advice. The firm adapted to each company's stage and situation rather than applying a standard playbook. This flexibility maintained a founder-friendly approach while providing substantial resources. The international expansion demonstrated how Sequoia scaled while maintaining culture. When opening offices in China, India, Israel, and Southeast Asia, the firm could have simply replicated the Silicon Valley model. Instead, they hired local partners who understood regional markets while deeply internalizing the Sequoia framework. Neil Shen in China exemplified this approach. He had worked at Sequoia in California and understood the framework thoroughly. But he also understood Chinese culture, business practices, and regulatory environment. He could adapt the questions about missionary intensity to Chinese cultural context while maintaining the core evaluation criteria. He built a team that was authentically Sequoia while being authentically Chinese. This localization strategy succeeded because the framework was based on human nature, not American culture. The desire to solve meaningful problems transcends geography. Missionary intensity looks similar across cultures even if it is expressed differently. Great founders attract great teams everywhere. Long-term thinking generates better outcomes universally. The principles traveled while tactics adapted. The success of Sequoia China and Sequoia India validated the universality of the framework. The firms backed some of the most successful technology companies in their respective markets using the same evaluation approach Valentine developed 50 years earlier in California. This geographic expansion also diversified Sequoia's exposure, reducing concentration risk while maintaining consistent quality. The challenge of maintaining culture at scale will only intensify as Sequoia continues growing. At some size, the firm will face limits to how effectively culture can transfer and how consistently standards can be maintained. The knowledge-sharing mechanisms that work for 50 partners may not work for 200. The apprenticeship model that develops exceptional investors may not scale indefinitely. The flat structure that preserves judgment may create coordination problems as the organization expands. These are classic organizational challenges that have no perfect solutions. Sequoia will have to continue adapting structures and processes to maintain culture and quality despite growth. They may need to accept some limits to size. They may need to develop new mechanisms for knowledge transfer at scale. They may need to sacrifice some growth to preserve quality. How they navigate these trade-offs will determine whether they can maintain excellence into future decades. The climate technology investments represent one example of how Sequoia adapted the framework to new sectors. Climate change is arguably the most important problem facing humanity. Technologies to decarbonize the economy are desperately needed. But climate tech has been notoriously difficult for venture capital because development timelines are long, capital requirements are large, and regulatory approval is complex. Traditional venture capital economics do not fit well. Sequoia's permanent capital structure and patient approach make them well-suited for climate technology. They can support companies through decade-long development cycles. They have capital scale to fund large infrastructure projects. They can help navigate regulatory complexity. They can attract missionary founders who want to solve climate problems. This positions them to profit from solving perhaps the world's most critical challenge. If Sequoia can demonstrate that backing exceptional founders solving climate problems generates strong returns, they will attract more capital to the sector. Other firms will follow. More entrepreneurs will tackle climate challenges. More innovation will occur. The compounding effects could be enormous. This is an example of how Sequoia's framework applied to important problems could generate both financial returns and social impact. The biotechnology investments follow similar logic. Developing new therapies for cancer, rare diseases, or aging takes 15 to 20 years and billions in capital. But the impact of success is profound. Curing diseases or extending healthy human lifespan are among humanity's highest aspirations. If venture capital can support these efforts effectively, the benefits extend far beyond financial returns. Again, Sequoia's patient capital and founder focus provide advantages. They can support scientists through long development timelines. They can help recruit business talent to complement technical expertise. They can provide capital at each development stage from research through clinical trials to commercialization. They can hold through the uncertainties inherent in biological research. These capabilities let them back missionary founders tackling biology's hardest problems. The common thread across these sectors is backing exceptional people solving important problems with long-time horizons. This is the framework's essence applied to new domains. The evaluation criteria remain consistent. Find missionaries with technical insights attacking problems that matter. Support them unconditionally for as long as necessary. The sectors change, but the approach remains constant. This adaptability while maintaining core principles has been Sequoia's defining characteristic across 50 years. They have invested through multiple technology waves, economic cycles, and leadership generations by staying true to the framework while evolving everything else. This combination of consistency and adaptation will be tested again as artificial intelligence, climate change, biotechnology, and other forces reshape technology and society. The artificial intelligence wave will test whether Sequoia can maintain its position during the most significant technology shift in decades. Artificial intelligence could reshape software, healthcare, transportation, manufacturing, and countless other industries. The winners will likely become some of the most valuable companies ever created. Can Sequoia identify and back those winners as successfully as they did with personal computers, the internet, and mobile? The framework suggests they can. The missionary founders building the most important artificial intelligence companies will care deeply about solving specific problems, not just deploying the latest technology. They will have technical insights that create genuinely superior products. They will think in decades, not funding rounds. They will attract exceptional teams. These traits will distinguish winners from the thousands of artificial intelligence companies raising money today. Sequoia's accumulated pattern recognition should help identify these founders. The questions that revealed missionary intensity in Steve Jobs and Larry Page should work for artificial intelligence founders too. The evaluation criteria that distinguished Instagram from dozens of photo-sharing apps should distinguish winning artificial intelligence companies from hundreds of competitors. The framework is technology agnostic because it focuses on timeless human qualities. The next decade will reveal whether this confidence is justified. Will Sequoia back the next Google and Facebook of the artificial intelligence era? Will they avoid costly mistakes as capital floods into overhyped opportunities? Will they maintain culture and standards as the firm continues growing? Will they transfer knowledge successfully to the next generation of partners? The answers will determine whether Sequoia's dominance continues. But regardless of future outcomes, the story of what Sequoia achieved over the past 50 years stands on its own. The firm demonstrated that systematic evaluation of founder quality generates better returns than analyzing markets or technologies. They proved that long-term partnership creates more value than transactional investing. They showed that institutional knowledge and network effects compound over decades. They built an organization that transferred culture and capabilities across multiple generations. These achievements provide lessons far beyond venture capital. Any field where identifying and developing exceptional people matters can learn from Sequoia's approach. The emphasis on intrinsic motivation over credentials. The systematic evaluation of character and capability. The patient support through difficulties. The long-term orientation. The commitment to learning and intellectual honesty. The building of trust through consistent integrity. The story of Sequoia reveals timeless truths about human nature and achievement. Great success requires both luck and skill. It requires being in the right place at the right time with the right preparation. It requires learning from failure faster than competitors. It requires relationships built on trust and mutual benefit. It requires patience when others panic and courage when others flee. Most importantly, it requires a framework. A systematic way of thinking that guides decisions, captures learning, and improves over time. A framework that can be taught, refined, and passed down. A framework that separates signal from noise, identifies patterns others miss, and creates sustained competitive advantage. That framework, developed over 50 years and applied to thousands of decisions, is Sequoia Capital's true legacy. Not the financial returns, though those are extraordinary. Not the famous companies, though those changed the world. The legacy is a better way of identifying and supporting exceptional people building important companies. That knowledge, that accumulated wisdom, that institutional capability will endure long after current partners retire and current portfolio companies mature. Don Valentine died in October 2019 at age 87. He lived to see Sequoia become the most successful venture capital firm in history. He saw the framework he developed validated thousands of times. He saw partners he trained become legendary investors. He saw companies he backed transform industries and change billions of lives. His obituary in the New York Times called him the grandfather of Silicon Valley. But that undersells his impact. Valentine did not just participate in Silicon Valley's creation. He shaped how it worked. He demonstrated that venture capital could be systematic, not random. He showed that evaluating founders was more important than evaluating markets. He proved that long-term partnerships generated better returns than short-term trading. Michael Morates, who worked with Valentine for decades, said this about him. Don Valentine taught me that investing is about people, not spreadsheets. He taught me to look for missionaries, not mercenaries. He taught me that the best products win even without business models. He taught me to be patient when others panic. Everything I know about venture capital I learned from Don. That knowledge transfer, from Valentine to Morates to Boa to the next generation, is Sequoia's most valuable asset. It is more valuable than the capital, the brand, the relationships, or the track record. Because knowledge compounds. Each generation adds to what came before. The framework gets refined. The pattern recognition improves. The institutional capability grows. 50 years from now, Sequoia Capital might look completely different. The partners will be different people. The markets will be different. The technologies will be unrecognizable. But if the firm still exists and still succeeds, it will be because the framework endured. Because new generations learned to identify missionaries and support them unconditionally. Because the institution valued long-term thinking over short-term results. Because the culture prioritized learning and truth-seeking over ego and politics. That is how institutions become immortal. Not through brilliant individuals, though those help. Not through lucky timing, though that matters. Through frameworks that capture wisdom and transfer it across generations. Through cultures that attract great people and make them greater. Through structural advantages that compound over decades. Through missions that outlast any individual life. Sequoia Capital achieved what Don Valentine envisioned in 1972. An institution that would endure like the sequoia trees it is named after. Growing slowly but surely. Towering over everything else in the forest. Surviving fires and storms that killed competitors. Standing for generations as a monument to patient capital, long-term thinking, and systematic excellence. The story of Sequoia Capital is ultimately a story about the power of frameworks and the importance of institutional knowledge. It is a story about how accumulated experience becomes competitive advantage. It is a story about how culture and values attract great people who compound that advantage. It is a story about how doing things right compounds over time to create extraordinary outcomes. That is the real lesson for anyone trying to build something enduring. Define your framework. Refine it constantly through experience. Transfer it systematically to the next generation. Build culture around it. Optimize for the long term. Stay humble and curious. Learn from every mistake. Compound advantages over decades. Never stop improving. Do that consistently for 50 years and you might build something that outlasts you. Something that matters. Something that changes the world. Just like Don Valentine did when he started Sequoia Capital in 1972 with nothing but conviction about what made great founders great and the discipline to act on that conviction repeatedly for 5 decades. The framework Valentine created was not just about making money. It was about understanding human nature at a fundamental level. He recognized that motivation matters more than credentials. That obsession predicts success better than intelligence. That missionaries outlast mercenaries. That product quality compounds over time. That great people attract other great people. These insights seem obvious now, but they were revolutionary in 1972. Before Sequoia, venture capital was largely about betting on industries or technologies. Investors asked what markets were growing, what technologies were hot, and what business models were profitable. Valentine flipped the equation. He asked who was building companies and why they cared. That single insight, executed systematically for 50 years, created trillions of dollars of value. The power of this approach becomes clear when you compare Sequoia's investments to their competitors' investments in the same era. In the 1990s, dozens of venture firms invested in internet companies. Most failed spectacularly. Sequoia invested in Google, Yahoo, and PayPal. In the 2000s, hundreds of firms invested in social networks. Most lost everything. Sequoia invested in YouTube, LinkedIn, and later Facebook and Instagram. The difference was not luck. Sequoia saw the same deals as everyone else. They passed on most of them. They invested in a small number where the founders had missionary intensity. That filtering mechanism, that systematic evaluation of founder quality, separated winners from losers. Consider the contrast between two search investments. In 1999, most venture firms invested in search engines. Dozens of companies raised money. Almost all failed. Only Google survived. Why? Because Larry Page and Sergey Brin were missionaries obsessed with search quality. They refused to compromise user experience for advertising revenue. They built for decades, not for the next funding round. Other search engines were run by professional managers optimizing quarterly metrics. They plastered ads everywhere. They made search worse to generate short-term revenue. They treated search as a commodity feature, not a mission. When Google launched with a superior product, users switched immediately. The mercenaries could not compete with missionaries. Or consider social networking. Between 2000 and 2010, hundreds of social networks launched. Friendster, MySpace, Orkut, Bebo, High5, dozens of others. Most raised venture capital. Most failed. Facebook won. Why? Mark Zuckerberg was a missionary obsessed with connecting people. He refused to sell for $1 billion. He focused on product quality and user growth over monetization. He thought in decades. Other social networks were run by people trying to flip companies to acquirers. They optimized for traffic to pump up valuations. They added features users did not want. They sold to Yahoo or AOL at the wrong time. They treated social networking as a business opportunity, not a mission. They lost to the missionary who cared more. This pattern repeats across every technology wave. In e-commerce, Amazon won because Jeff Bezos was obsessed with customer experience. In mobile operating systems, Apple won because Steve Jobs was obsessed with integrated hardware and software. In payments, Stripe won because Patrick and John Collison were obsessed with developer experience. Missionaries beat mercenaries every time. Sequoia's genius was recognizing this pattern and building a systematic process to identify missionaries before everyone else. The framework had several components. First, source deals through the network before they became competitive. Second, spend extensive time with founders to assess their motivation. Third, ask questions that revealed whether they were missionaries or mercenaries. Fourth, move quickly once conviction was established. Fifth, support unconditionally for decades. The questions Sequoia asked were designed to reveal truth. They did not ask about financial projections. They asked why the founder cared about this problem. They did not ask about market size. They asked who the founder's first 10 hires would be and why. They did not ask about exit strategy. They asked what the company would look like in 20 years. These questions filtered ruthlessly. Mercenaries could not answer them convincingly. They did not have genuine passion for the problem. They could not articulate a long-term vision. They could not explain why this problem mattered beyond making money. They revealed themselves quickly. Missionaries answered differently. They told stories about personal experiences with the problem. They described details that showed deep understanding. They articulated visions that were ambitious but grounded in reality. They radiated authenticity and conviction. They made you believe. The interviewing process also revealed technical depth. Great founders understood their product better than anyone else in the world. They could explain technical details to engineers and translate them for non-technical people. They knew what was possible and what was not. They had insights that came from years of working on the problem. Sequoia also evaluated team-building capability. Great founders attracted great people. They could recruit engineers from Google, designers from Apple, operators from Amazon. They created cultures where talented people wanted to work. They articulated missions that inspired. They gave people autonomy and ownership. The quality of the first 10 hires predicted the quality of the next 1,000. Another crucial element was learning velocity. The best founders learned faster than anyone else. They ran experiments constantly. They talked to users obsessively. They read everything in their field. They synthesized insights from different domains. They updated their beliefs based on evidence. They were intellectually honest about what they did not know. This was critical because initial ideas were almost always wrong. Every successful startup pivoted multiple times. The founders who succeeded were those who learned fast enough to find product-market fit before running out of money. That required intellectual humility, willingness to admit mistakes, and capacity to change direction quickly. Sequoia's post-investment support reinforced these qualities. Partners met with founders regularly, not to control them but to help them think clearly. They asked hard questions. They shared pattern recognition from other companies. They made introductions to potential customers, partners, and hires. They provided emotional support during difficult times. This approach created loyalty that compounded over time. Founders who succeeded with Sequoia's help became advocates. They referred other founders. They angel invested alongside Sequoia in new companies. They provided advice to other portfolio companies. They stayed connected to the firm for decades. The network kept expanding. The network effects became self-reinforcing. By 2010, Sequoia had backed so many successful companies that the alumni network included thousands of founders, executives, and employees. When anyone in that network started a new company, Sequoia heard about it first. When Sequoia companies needed to hire, they could tap into the network. When Sequoia needed introductions to customers or partners, the network provided them. This created an information advantage that competitors could not match. Sequoia learned about opportunities months or years before they became widely known. They could conduct due diligence by calling portfolio company founders who had worked with the person in question. They could assess market opportunities by talking to operators in the field. The network was a proprietary source of truth. The brand advantage also compounded. By 2015, Sequoia was the most prestigious name in venture capital. Founders wanted Sequoia on their cap table for signaling value. Sequoia's investment gave credibility with customers, partners, and future investors. It helped recruit employees and generate press coverage. The brand became a product in itself. This created a virtuous cycle. The best founders wanted Sequoia backing. That gave Sequoia access to the best deals. That generated the best returns. That enhanced the brand further. That attracted even better founders. Each cycle strengthened the firm's position. The success Sequoia achieved over 5 decades represents one of the most remarkable stories in business history. The firm identified exceptional founders and supported them through the entire life cycle of building companies. They compounded advantages through network effects, pattern recognition, and cultural consistency. They remained patient when others panicked and selective when others compromised standards. The result was an institution that stood apart from every other venture capital firm. An organization that demonstrated the power of long-term thinking, systematic frameworks, and committed people. An enduring legacy that will likely influence investing, entrepreneurship, and innovation for generations to come. This is the story of Sequoia Capital.